Hello, welcome back to the continuing lecture in investments. So now we need to move on to the risk premiums and risk aversion. Now, risk premium, we already know these concepts from already Finance 100. A premium is a kind of reward for over and above um, um, the risk-free rate, right? Over and above the risk-free rate, or taking the risk, right? Um, so that already subsumes the concept of risk-free return, and we already know. We also know from Finance 100 what uh, risk-free rate is. Um, Risk-free rate is the literally the rate you can earn without any risk, without taking any risk. And of course, in the economy, in macroeconomy, uh, there is actually, 3 month to 1 year Treasury bill is return on 3 month to 1 year Treasury bill is a proxy for a risk-free rate, risk-free return. Of course, CDs, return on CDs, yes, risk-free. Return on uh, savings account, risk-free. There are just a couple of risk-free, returns in reality, but they are all related to uh, uh, basic bank interest rate. Because when you put your money in the bank, right? Uh, it's very, 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 immaterial these days. What do you earn on savings account? You earn probably 0.1%, not even 0.1%. But even though it is less than 0.1%, at least it is, guaranteed, risk free. If you don't like that, of course, you can put your money in the CD. Still, that's guaranteed. Yet, very, mediocre return these days. Just about 1%, 2% at best. Even 2% CD, you don't see that anymore. But anyway, because there are risk-free returns, which you can earn without taking any risk. There should be a reward for taking the risk. Of course, if you goes without saying, right? It is called, expected return earned can be earned in excess of the risk-free rate, in excess of that on risk-free securities. It's called risk premium. Okay. And then what is excess return? And then there comes the we already understand. Oh, if it is over and above risk free, isn't that excess return? Yes, but then aren't they the same thing? Was the in essence, mathematically they are the same, but excess return is rate of return in excess of risk free return. but realized, that have been realized from the past data. So you calculate all the excess returns, because when you have past data, which is of course past data, past risk-free returns and past actual returns, and all those excess returns minus risk-free return is called excess return, right? All those returns minus risk-free rate, excess returns. And what is expected? What is expected return? Expected return is basically the average of the past returns data. So that that brings us to the definition of what expected risk premium is. Expected risk premium is average excess return, right? Average of all excess returns, and it is expected risk premium. Now again, here the uppercase R is being used as the symbol for excess return. Okay, normally for expected return, for return, usually, rate of return, lowercase, right? But if uppercase R is for risk premium or excess return, okay? And of course, it's the excess return that we are all in finance. We are in investing. We are interested in investment. And if you are investing, it's all because of that excess return, right? You want to maximize that excess return. And I mean, the return will always be higher when you take more risk, but how much more risk do you want? I mean, you don't want to take maximum risk to get maximum return. And even if you get maximum return, maximum excess return, if your risk is too high, then the efficiency of that return goes down, right? I mean, let's say you got like 100% return, but the risk, which is a variance, right? If the variance was 90%, or even if the risk was the variance was 200%, right? The variance 200%, your return expected return 10%, 100%. That's not a very efficient right? Mean variance ratio, right? Or return risk ratio. So we have to actually we need to have a metric, right? We can measure the efficiency of return. It's called the price of risk. Price of risk. Ratio of risk premium. It's the ratio of risk premium to variance. Okay, so it is defined as expected return. I mean, this is the excess return, right, or risk premium, right? Because it is expected, right? Risk premium, right? On RQ, that's portfolio Q. It's just arbitrary, a name, arbitrary name given to a portfolio, right? So that's risk premium over variance. risk premium. Yeah. Oh no, this is variance, right? And uh, and the symbol for price of risk is A. Out of all and out of all the letters, out of all the characters, they picked A for risk, uh, price of risk. And since A sounds like A looks like it stands for aversion, right? Risk aversion, right? Why? What does it have to do with risk aversion? Of course, risk aversion is literally the tendency to avert risk, right? Everyone has uh, it's any rational being's tendency to avoid risk, right? And of course, depending on risk tolerance, some people are more risk tolerant, some people are then more risk tolerant than uh, um, other people, other average investor, then they're risk takers. I mean, it's relative. Someone is more risk taker than, but everyone is basically everyone is willing to uh, not willing to take too much risk. I mean, up to a certain point, you have to take the risk, right? Um, so because the symbol is A, why? I mean, this is risk premium to uh, a variance ratio. Why is it A? And but it's price over price is basically what you have to pay, right? Um, price is what you have to bear, right? For fruit, right? And this is basically fruit, right? The numerator is the fruit, and this is the price, actually, and this is the risk, right? Yeah. This is the risk, right? Now, and then let's think about it. Uh, variance is usually I mean, our mean is usually a positive number, positive, percentage, right? Risk-free return is already positive percentage, right? If the risk-free rate is, 3%, right? Most, portfolios or most assets, you wouldn't be looking into any asset that has less return than risk-free rate. So risk premium is usually a very positive number, like 3%, 5%, 6%, 8%, 10%. And compared to that, variance be a very smaller number. Why? Because variance is square root. Variance is the square term of standard deviation. The standard deviation would be also something like if return is 10% and standard deviation 5%, or return 5%, standard deviation 10%. Even if standard deviation is, even if the standard deviation would be usually like that, would be greater than the average return, and the standard deviation would be if the average return or the mean return is 5%, standard deviation would be say 10%. But the square term, the variance of that standard deviation, the square term would be think about it. 0.1 squared will be 0.01, right? 0.01. So the variance would be a quite smaller number than the standard deviation. And the standard difference in the magnitude is quite obvious. So if you divide the risk premium by the risk invariance, right? That number will be usually greater than 1, right? That ratio will be greater than 1. So yeah, then this makes sense. You know, people would tend to see how, you know, the multiples. You know, how many times the risk premium is of, you know, how many times um, the risk is the risk premium, right? And conventionally, the price of risk has been, you know, somewhere between 1.5 and 4, right? But of course, if the denominator was, you know, standard deviation, this number wouldn't be, you know, greater than 1. It will usually be between 0 and 1. But anyway, this is called, you know, price of risk. And then market price of risk. There is, you know, now the market concept of market price of risk is, you know, now easy to understand. It's not that difficult to understand. The average risk aversion using S&P 500, average, you know, price of risk using S&P 500, because S&P 500 represents the market. And so assuming all short-term borrowing is equal to lending, which means, you know, all the lending is what? Basically, you know, lending comes from savings in the economy, right? So if all the funds, you know, saved, which are, you know, which can be invested, basically, right? So meaning, you know, all the investable funds are invested, right? Fully invested, right? Then average investor holds a complete portfolio represented by stock market index. Yeah, a complete portfolio will be a concept discussed later, but complete portfolio is a portfolio consisting of risky assets, portfolio consisting of risky assets and risk-free assets, right? So basically, you know, if all the funds are either being invested in, you know, all, you know, treasury or, you know, stocks or bonds, you know, with some risk, all the fungible funds or all the investable funds are invested. And then, you know, what would be the price of price of risk for the entire market, and it's not a difficult thing. This is average market return minus market risk premium, right? That's market risk premium, really. And then sample variance of the market. I mean, sample variance, yes, because my sample variance is not population, right? S&P 500 is not the population of the entire financial market. So, although it's a good proxy, very good proxy, still, it's sample, right? 500 companies, are a sample, not the population of the entire economy, right? So, and sample variance is simply, calculation of, variance of the sample data, subtract 1. You're not dividing it by n. It's n minus 1, right? And in the U.S., right, S&P 500 price risk of the, price of risk of S&P 500 has been generally 2, right? It's been 2. So this really bothers me. It's a pet peeve. Arrowhead. Okay. It's a kind of pet peeve. Okay. Don't think I'm, please don't think I'm artistically challenged. It's just so difficult with the mouse to draw with. Now, so remember, price of risk is, risk premium over variance. And I said, what if you divide it by standard deviation? I mean, the gist is the same thing, but if you divide it by standard deviation, it will be a much smaller number, right? The standard deviation is greater than variance, because when you're dealing with percentages, right? Percentages are numbers between 0 and 1. So obviously, when you square it, it will become smaller. Square root is bigger number. So if you do that, it's called a Sharpe ratio. Sharpe ratio. In other words, if you use standard deviation, and usually you do, Sharpe ratio is only for portfolio. Okay. You do also, price of risk for portfolios, but you can, and because we are, usually these ratios are for aggregate data, right? Don't apply to individual assets, but there's no there's no restriction. I mean, there's no law that says you cannot apply this to individual. But the point is, applying it to individual assets isn't very meaningful. I mean, it is, it's useful in its own right. They just don't do it for individual assets, but you can. And Sharpe ratio is strictly, portfolio application, right? So basically, Sharpe ratio is a very important indicator, very important metrics for measuring efficiency of the portfolio, because it's the reward to volatility. It's also called reward to volatility ratio, right? Portfolio analysis in terms of mean and standard deviation of excess returns. So it's called mean variance analysis. And mean variance analysis is nothing but ranking portfolios by Sharpe ratio. And it's only a valid statistic only for ranking portfolios, not for individual securities, right? And you would see, also you would often see trainer ratio. It's like Sharpe ratio. I mean, they are basically risk premium, efficiency of the risk premium, but it is, pretty much the same concept, but the denominator is beta, right? Denominator is beta, not standard deviation. But more than trainer ratio, you would see, Sharpe ratio more often, right? So we're gonna, in the next video, we're gonna look into the actual historical data. Actually, the book is actually talking about the one more thing they are talking about is the inflation. And before going into actual data, they are talking about inflation and real rates of return, because after, even though nominally, if it is 15% return, after adjusting for inflation, and what is the actual punch, what's the actual real return? That would be an interesting concept, and it's not a difficult thing. This is Fisher equation. We talked about Fisher equation at the beginning. I mean, the full-scale, fully fledged Fisher relationship, Fisher equation. We talked about that when we, I believe, at the earlier part of part of the semester, because this is, I told you, this is a normally this is the Fisher equation. I normally use I for nominal interest rate, right? But the textbook uses uppercase R. And this is where I don't like, this is what I don't like about inconsistency, because but sometimes sometimes if it is inevitable, you will have to do that. But in this textbook, they unnecessarily chose to become inconsistent in the use of symbols, because previously uppercase R, I said uppercase R represents, it's the symbol for risk premium, right? So it can cause confusion. So but just for the inflation, the Fisher equation purpose, just just take R for nominal interest rate, right? But I told you already that the this Fisher equation is an approximation, right? And actual, so real interest rate is nominal interest rate minus inflation, right? And this is only an approximation, I told you, right? But I told you the actual relationship is like this. This is the actual, so um, looking into historical data, right? You would have to make some adjustments for. I mean, the data. The study they did with like 85 years worth of data starting from 1926 all the way to 2010, a huge data series, right? They also did they also looked at real return, not just nominal return. So before looking at the data, it's worth noting how the real return is calculated, right? Okay, so with that said, I think I will have to cut off the video at this point because it has run more than like 30 minutes. So we will look into the study, done, with the huge data set, in the next video. Okay, I will see you guys in the next video. Stop recording.